Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist at WealthPress. Today is Wednesday. It is the 10th of February. We're halfway through the second week in February of 2021. The market's going to open up in about an hour and 20 minutes or so. Let's get into it right now. That's what I always say. Now, as I mentioned earlier this week, there's not a lot of Fed data this week. This is actually the lightest Fed week data of the year so far. But we've got the second half of earnings, and I'll get into earnings probably on Friday. I like to wait for the whole week to finish off before I get into it. The first half of earnings finished better than expected. Numbers were up about 90%. 90% of stocks did better than expected on revenue and earnings. But remember, those numbers have been beaten down to death over the past several months or the last several quarters. The big report of the week is going to be jobless claims. Last week, that's going to be tomorrow. Last week, the numbers surprised everybody and actually came out to 779 after jumping to 965 about a month earlier. And that was getting me worried, but it looks like it's coming down. My key concern is that the number continuously goes down, not stays in a range between 700,000 and 965,000 unemployment claims each week, which is crazy. And right now, it's really telling us the number is still elevated and it's not going down as fast as we would like. And the reason why I pay attention to this report is because this report gets updated weekly, not monthly, not annually, weekly. So it's like every 7 days, so it doesn't trail too back behind, and it gives us an actual, almost down to a real-time estimate of how bad the employment world is. And right now, the moving average is at 848. I really want to see it start aggressively going down. If it does, then it's going to tell me that the impact of the COVID is not as bad, and or that the vaccine is having some impact on the working class. Because if older people keep getting it, then the working class still doesn't, and it's not expected to get it till about April, May. Where does that leave people who are looking for jobs and employed? It's not a good position. So I want to see this number below the 4-week moving average. Consensus is 803,000. I would love to see the number near 750, 700,000, keeping my toes and my fingers crossed. Now, in terms of the overall market sentiment is stronger. The market broke after 6 up days yesterday for the first time. We're still near all-time highs. Everybody and their mother is waiting for this stimulus, and that's what's driving this market. As I mentioned to you guys over a year ago, or no, not over a year ago, a little less than a year ago, almost a year ago, that COVID and what happened last end of February, beginning of March is what's going to shape the economy for a few years to come. And I meant it, and we're still there. We're still riding that story. So the market's a little higher. Looks like we're going to be at new highs again. And I'm going to say that this market is unstoppable. But again, I showed this to you yesterday. It was like around 70, 69. Now it's at 67. This is the put to call ratio. And I know what you're saying. You told us so before, but I'm telling you folks, we're getting down to the 60, 67, 65 level. That means that rubber band is really, really favoring the bulls a little too much. And it looks like we're going to have a pullback. And when you take this account with the fact that the overall stock market is diverging, and I've talked about that many, many times, and the RSI level can't get to overbought level at this point, that's telling me the market is too bullish, and we are, in fact, going to have a pullback. Now, to give you some idea of the type of pullback, let me, I don't know why, I'm picking these stocks that have nothing to do with what I'm showing you. I guess I'm just being silly. This is the S&P 500. Notice price is moving higher. Look at momentum levels. The RSI, when we're at 357 or 3,570, the RSI balloons to 86. Now we're almost at 393. We're almost at 4,000 if you add the 0 to the end and make it the S&P 500 instead of the SPY. It has the extra digit. The RSI can't even get to 60 to 70. That is one hell of an overbought and diverging market. Diverging? Yes. Higher price, lower momentum levels, lower highs. And when you combine that with the put to call ratio, so this is a rubber band. This is its usual movement. It's like this right now. It's like this, and it's going to pop. And I'm not kidding. And most likely, we're just going to hit the 50-day moving average. There's a good chance we'll hit the twilight zone. We need this right now. We desperately, desperately, desperately need this right now. Otherwise, momentum levels will stop the market from going back up, and we'll just keep stretching and pulling back, and eventually the market will enter a choppy cycle. If we want to continue moving higher, and I think the market is still in a very bullish phase in light of all of the stimulus, there's a really good chance we're going to see it, but we got to get through this divergence, and the only way to do it is to a pullback. Expect a pullback to the 50-day moving average, to the 375 or the 3,750 level, depending on if you're looking at the S&P 500 or the SPY. And there's a really good chance we'll hit the twilight zone. The put-to-call ratio will back up to about 875 or so, and then we'll come back down. But I am very, very fearful because the put-to-call ratio was neutral, and it's neutral most of the time, but not right now. When it breaks 70, it's telling me that the bulls are, their days are numbered, at least in the short term. Now, in terms of global economy, Wall Street broke a 6-day winning streak, but based on what we're seeing, it looks like we're back up. President Biden, Democrats plan to move ahead without Republican help on the stimulus plan, which is why the market is sitting at all-time highs. Investors' optimism has been helped by a rollout of the COVID vaccines and the Federal Reserve's promise to support the struggling economy, which again is the only reason why the market is doing what it's doing, and it's just going strong, because the economy is not 100%. It's pretty fragmented right now. You guys all know that. I've talked about it many times. Companies, now pay attention to this and maybe you want to write this down. Companies that deal with consumer services and products were the biggest drag on the broader market, outweighing gains in communications, industrial, and healthcare stock. So consumer services and products were the biggest drag on the broader market in terms of earnings. And we're only about 65 to 70% done. So I'll wait till Friday and I'll give you more info. U.S. stocks have risen on optimism that the worst economic impact of the pandemic might be in the past. I'm hoping. I'm hearing that Pfizer's vaccine is effective against the South African strain, or what might not be the one that's impacting Europe right now. Folks, ultimately the market is in fact looking past this COVID. But if we find out that things are not looking as smooth, or the vaccine is not as effective, or there's more people getting infections, we are going to go down. Now, I don't necessarily believe the market is ready to go down a little bit because of COVID. I just think it's technically overbought. It is just stretched out. That rubber band is stretched out, and it needs to contract. And I'm telling you, just look at these numbers. How often do you see it go below 65? Not often, and it's at 67 right now. Democrats have rallied around Biden's $1.9 trillion stimulus plan for the struggling economy, and it looks like we're going to have minimum wage of $15 an hour. I remember when minimum wage was like $7 an hour. Do you guys remember that? That was a while ago. Now, in terms of the market, we're still bullish. We got to stay with the trend. I've got two stocks that I like. One stock is an inside day. What's an inside day? It's when you have a higher high, like a 90-day high, and then the next two trading sessions are inside. Whenever you have inside days, you have lower volatility. Whenever you have lower volatility, you have less risk. Whenever you have less risk, you have a higher reward to risk ratio. So I like this stock. I like the fact that it's just sitting right near this upside as the market is pulling back. So it's showing us good relative strength. I would be entering right at the 39. I would wait for it to go up to about 39.50 and buy there. And I would put a sell stop right at this 10-day moving average line, which is around the 36.50 level. That's one stock I like. That's a momentum play, and that's NVST. And I've talked about this stock before. What does the stock do, you may ask? Manufactures and sells dental products. 1-year return is 35% on this stock. Folks, when economy hits a bump, people still need dental products. They really, really do. So the fact that it's dental equipment and supplies kind of flies under the radar, if you will. I like this stock. And again, ticker symbol is NVST, and the name of the company is Envista Holdings. Next stock on my list, Wesco International. What do I like about this stock? Well, it made an all-time high, and then it pulled back below the 50-day moving average. I call this tail gap. Or, in the old days, I would call this setup the Gilligan Island. Why do I call it the Gilligan's Island? Because the price pulls back away from the trading action. So it looks like This is the trading action, and this price bar looks like it's on an island on its own, and it wants to come back to everyone else. So I call it the island pattern or the Gilligan's Island. I started doing this when I was young, okay? So nothing changed over the last 27 years. So what I believe is when you have a pullback that far below and it hits the 50-day moving average, what I like to do is wait for it to start trading above the 50-day moving average. So I would put a buy stop right around the 79.50 level. And if it hits it, I would put a liquidation stop right at the 69.80 level. So if it starts moving back in its trend above the 50-day moving average, the odds are the Gilligan's Island will go, the bar price action will take it back home to the mainland. This is the mainland, and this is the island. Pretty funny, right? Gilligan's Island. I used to love that show when I was a kid. So anyway, I wouldn't buy it here. I would wait for it to break above the 50-day moving average right around the 79.60, 80 level, and put a liquidation level at right around the 70 level. And if it breaks above, the odds are it'll come back up and snap back up to this level. And again, I would only wait if it broke above the 50-day moving average to the upside. Now, before I let you go, I've got something important for you. The world's number one pre-market expert, Tom Busby, and I, we just cracked an all-new style of trading. We've developed a way to spot which stocks are likely to deliver the largest gains every single day before 9:30's opening bell. Now, here's the thing. You do your analysis before 9:30, but the trades go in after market opens. So you do what we're doing right now. You analyze the market. Well, you don't have to analyze the market. Let Tom and me analyze the market. And then you trade during regular trading hours. It's already given everyday traders a chance to win 20 out of 22 trades. That's 10 out of 11 trades. That's like 4.5 out of 5 trades. Can you imagine winning 4.5 out of 5 trades? That's crazy good. And that's a huge advantage. That's a huge, huge advantage. And if you haven't seen our presentation yet, click on the button below and watch it now, like right now. Don't miss out. And make sure to like this video and subscribe to this channel if you're watching on YouTube. Post comments for me. Stay one step ahead of the market by being the first to be notified when we post the next video. I'll talk to you guys tomorrow and have a great, great day. Keep your eye on this put to call ratio. I'm not happy about this. And follow the link below. Bye, guys.